In the year 2023, China realized that more than $106 billion had simply disappeared. This is not an exaggeration. It's not a prediction. This has already happened. This money was invested in Venezuela, and now it's turning into one of the biggest cases of strategic loss in recent history. And while most still think this is just a problem between the Chinese and the Venezuelans, Beijing has already pointed the finger at the culprits, the United States. If you think this doesn't affect your wallet, think again. Because this movement is reshaping debt agreements, access to oil, and even who dictates the rules of the game in Latin America. The truth is, most people aren't even paying attention. But by the end of this video, you'll understand exactly how this hidden financial collapse reveals a pattern that is about to repeat itself in other countries. And if you understand this now, you'll have an advantage when the next domino falls. $106 billion. That's the amount China poured into Venezuela over a little more than a decade. But what was supposed to be a strategic investment became a financial black hole. The detail that almost no one notices. This money didn't just disappear from accounting balance sheets. It evaporated in broken contracts, unfulfilled promises, and oil that never arrived. This is where everything starts to change. Most of this amount was loaned in the form of oil for loans agreements, that is, Chinese money in exchange for Venezuelan oil. In theory, a masterstroke, guaranteed energy, growing influence in Latin America, and a solid financial return. But in practice, what Beijing bought was instability, and that comes at a very high price. Venezuela's oil production collapsed. Shut down refineries, international sanctions, systemic corruption. All of this turned the promised barrels into mirages. Meanwhile, oil payments were increasingly delayed, of inferior quality, and were still at a discount. What seemed like an advantage turned into a trap that drained cash and bargaining power. Now imagine this on a larger scale. Billion-dollar contracts hastily renegotiated, deadlines extended, and a growing sense that China has lost control. The central point. It's not just the money, it's the geopolitical influence built on that money. And when it starts to crumble, other players enter the game. And if you think this was an isolated incident, wait until you see what China really wanted with this investment. Because what's at stake here wasn't just profit, it was power. And in the next segment, we'll reveal what Beijing really bought with those billions. Most people still think that China invests thinking only about financial return. But that's a mistake. The case of Venezuela shows that more than profit, what Beijing wanted to buy was energy security in a strategic position. And it is precisely here that everything starts to make sense. Venezuelan oil was not just a commodity, it was a shield. With gigantic reserves, Venezuela promised to supply enough energy to sustain Chinese expansion for decades. That sounds simple, but it isn't. Having this energy source outside the Middle East, far from routes controlled by the United States, was a bold geopolitical move. And that changes the whole game. This is where a detail that almost no one notices comes in. The Chinese billions were channeled through state-owned banks and state-linked companies. Not coincidentally, the same players leading the Belt and Road Initiative. China's presence in Venezuela was part of a coordinated movement to establish a presence in the United States' backyard. It wasn't just investment, it was symbolic territory. The plan was clear: finance infrastructure, oil, telecommunications, and position Venezuela as a strategic link in the new Chinese trade route, a Latin American satellite within Beijing's orbit. But this plan had a problem. It presupposed that the country was at least minimally stable, and Venezuela was, in fact, a powder keg. What China didn't expect or chose to ignore was that by establishing such a strong foothold in Venezuelan soil, it would also be plunging into the heart of a historic dispute with the United States. And this dispute, as we will see, always follows the same script. A cycle that begins with optimism and ends with losses. And the most curious thing, it always has the same 4 stages. There is a silent cycle that repeats itself every time a superpower tries to use money to gain influence. And this cycle, ignored by most, has 4 clear stages. China is reviving this pattern now, but it has already destroyed empires in the past. And the most dangerous detail is that it all begins with an illusion. Stage 1, the creditor's illusion. Here, the investor, in this case China, believes it is in control, that the contracts are solid, that payments will come, that the asset is guaranteed. It's a stage of blind trust, where charts project growth and nobody wants to hear about risk. This is where everything seems too easy. And this, historically, has always been a warning sign. Stage 2, the trap of continuing to lend. When the first delays occur, the lender prefers to protect the investment rather than face the loss. So they lend more. They restructure. They extend deadlines, renegotiate terms. It seems rational, but this is where the hole deepens. The debt grows. The dependence grows too. The lender is no longer in control. They are trapped. And the feeling of control begins to crumble. Stage 3, rupture. At some point, everything breaks down. It could be a political crisis, a technical bankruptcy, or external intervention. But the result is the same. The payment flow collapses, the local currency melts away. Contracts lose their practical validity. And what was once a guaranteed investment becomes a legal, diplomatic, and strategic battle. It is at this point that the true owners change. Stage 4, asset transfer. With unpayable debt and the country in shambles, assets need to change hands. Whether formally or covertly, infrastructure, mines, ports, and oil fields begin to be traded for pennies. And the new power that emerges to buy is not always the original creditor. This is where many lose everything, and few buy cheaply. This pattern has happened before with the United States and Mexico, with the IMF in Southeast Asia, with the United Kingdom in Africa. Now, it's China's turn in Venezuela. And most impressively, Venezuela has already gone through almost all the phases. The next section will show, step by step, how this unfolded and exactly where we are now in this cycle. It all began in mid-2007, when China inaugurated its golden age with Venezuela. The promise was simple: billions in loans in exchange for oil. The model? Oil for loans, contracts where Venezuela would repay its debts with barrels of oil shipped regularly. What almost no one realized at the time was that this was the first step in the trap. It seemed like a safe exchange, but only if the oil came. Production, however, did not come as expected. PDVSA, the Venezuelan state-owned oil company, plunged into technical collapse. Refineries were shut down, equipment was dilapidated, and there was an exodus of human capital. And all this was aggravated by an increasingly authoritarian and isolated regime. The result? Incomplete, delayed deliveries, and deliveries below the promised quality. It was at this moment that the creditor's illusion began to crack. The next step came almost as an automatic reflex. China continued lending. They created new agreements with longer terms and more flexible conditions. They restructured debts so as not to have to declare immediate losses. But in doing so, Beijing only deepened the dependence and strengthened Nicolas Maduro's bargaining power. It was the second stage of the cycle, exactly as in the previous cases. With the pressure of American sanctions, Venezuela began delivering oil at a discount. In some cases, the barrels were worth less than half the market price. This seems small, but it isn't. This implicit discount was a disguised write-down. China was already losing billions. It just couldn't admit it yet. The game had changed, and the real power was no longer with those who had been financing it. And then came the final stage, total fragility. The country collapsed, the economy melted down, the currency turned to dust, and now the very assets that China financed are vulnerable to reappropriation, whether by new governments, local interests, or external pressures. What Beijing still doesn't know is whether it will be able to keep what it bought. And who is already repositioning itself is Washington. In the next segment, we're going to talk precisely about this turning point, the moment when the United States returns to the game, and why this could mean the end of Chinese contracts as they were originally signed. 2022, a key year, silent but decisive. It's when the United States begins to change its stance towards Venezuela. After years of isolation, sanctions, and aggressive rhetoric, Washington opens channels of direct dialogue with Caracas. What's behind this? Oil. But the detail that almost no one notices is that this move could nullify years of Chinese investment. The real turning point comes when the White House, pressured by a global energy crisis and the war in Ukraine, begins to flirt with a pragmatic rapprochement with Nicolas Maduro. The focus? To guarantee access to Venezuelan oil for the West. But there's a problem. Part of this infrastructure has already been financed by China, and here begins the silent struggle for control and influence. This sounds technical, but it's not. It's pure geopolitics. When the United States returns to the table, they don't accept the status quo built by Beijing. They want to rewrite the rules, renegotiate contracts, and influence local decisions. And the Venezuelan government, weakened and short of cash, begins to signal openness. This changes everything for Chinese contracts. What was guaranteed is now in jeopardy. This is where things start to spiral out of control for Beijing, because the game ceases to be financial and becomes political. American pressure translates into new alliances, more attractive offers, and even a reconfiguration of concessions. In other words, whoever controls the assets that China paid for, oil, infrastructure, telecommunications, may no longer be China. And if you think this movement is isolated, think again. The pattern is clear. Where there is collapse and unpayable debt, there's an opportunity for strategic re-entry. The same logic that China has applied for years is now being used against it. And the next stage of this story reveals a domino effect that is already beginning to impact several other countries indebted to Beijing. When Venezuela begins to effectively rewrite its contracts with China, extending deadlines, delivering oil at a discount, avoiding direct collection, a new kind of signal is sent to the world. not to the markets, but to governments indebted to Beijing. And that signal is direct. China may be tough on agreements, but it's not so good at enforcing them. This may seem insignificant, but it's not, because a contract on paper is one thing. The ability to enforce it in the real world is quite another. When a country like Venezuela goes through all the stages of collapse and still maintains some control over its assets, the message is dangerous. Perhaps China won't be able to recoup what it financed. Perhaps its pressure has a limit, and this perception spreads quickly. This is where the domino effect begins. Pakistan, Kenya, Sri Lanka, Zambia, Ecuador, all of them in some way are rethinking their relationship with Beijing. Whether by requesting restructuring, delaying payments, or trying to renegotiate terms, the lesson from Venezuela has become an unwritten manual on how to deal with the world's largest creditor. And with each country that resists, the Chinese model weakens. The detail that almost no one realizes is that this isn't just a matter of money. It's a crisis of confidence in the very financial engineering of the Belt and Road Initiative. If contracts aren't enforceable, if assets can't be recovered, if the creditor is perceived as weak at collecting, the risk is reversed. And what was once an instrument of power becomes a liability, and it is in this vacuum of authority that other actors enter. Western institutions, private funds, local governments, all realizing that assets financed by China are vulnerable, discounted, and open to new takeovers. In the next section, you will understand exactly where this risk can hurt, and where opportunities may arise for those who are attentive. Now comes the part that few people are seeing, the real impact of all this on the money. When billion-dollar contracts are informally renegotiated, when assets are handed over at a discount, and when the creditor loses control, what happens is this: someone will have to bear the loss. And the first to feel the blow are the very Chinese banks and state-owned companies that finance this game. China may not admit it publicly, but the signs are already there. Silent write-downs, tense diplomatic renegotiations, and an increase in the systemic risk of the Belt and Road model. This seems distant, but it's not. Because every time a country defaults or delays its debt, the whole appears on the balance sheets of those who financed it. And when you add Venezuela, Pakistan, Kenya, and company, the whole already exceeds $100 billion. But this is where the loophole appears. Whenever one empire weakens, another moves in. And the assets that were in the hands of Chinese state-owned companies, refineries, mines, ports, power grids, are now vulnerable. Many of these contracts have clauses that are suspended, frozen by instability, or simply forgotten. And in this vacuum, buyers emerge. Opportunistic funds, Western companies, or even governments allied with the US. The detail that almost no one notices: these assets are good. Some of them have enormous strategic value, but they were poorly managed, hampered by unpayable debts, or embroiled in geopolitical disputes. And now they can change hands for fractions of their original price. Whoever understands the cycle now, before the complete turnaround, can enter at a decisive moment. Ultimately, this isn't just the collapse of a Chinese model of expansion. It's a global redistribution of assets and power, and those who are left out of this movement will simply watch the board being rearranged without being able to play. All of this that you just saw has happened before. Empires that borrow too much lose control and see their assets changing hands. What changes are the names, but the pattern is always the same. The big question now is, at what stage of the cycle are we? Will China be able to react, or are we about to see a new geopolitical reshaping, with the United States once again dominating the backyard they considered lost? And more importantly, what are you going to do with this knowledge? Because understanding the pattern is one thing, but positioning yourself before the turnaround is what separates those who observe from those who profit. So if you want to keep seeing what almost no one else is seeing, subscribe to the channel now, turn on notifications, and leave a like so this video reaches more people. On the final screen, there's content that will further expand your understanding of what's behind major global financial collapses. Click there, it's the next step.